What's up everyone, welcome to Stockton. It's a pleasure to meet all of you. On this channel, we talk about stocks before they start blowing up, say goodbye to chasing stocks at all-time highs, and say hello to making some money. So if this sounds like something you want to take advantage of, then hit that beautiful subscribe button and like the video. Now let's get to it. Before we get into the video, I have to say that I'm not a financial advisor. Anything I say is just my opinion and is for entertainment purposes only. Having said that, if I'm talking about a company, I'll let you know whether I'm personally going to invest in it or not towards the end of the video. But you should always do your own due diligence, so with that out of the way, let's get started.
Hi guys, I hope you're all well. In today's video, I just wanted to provide you with some insights that I hope you'll find useful when it comes to preparing for a market crash. A market correction is when the markets tank by 10%. A bear market is when the market tanks by 20%. And a market crash is when the market tanks by 35 to 60%, which lasts for about 3 to 6 months. This week what we're seeing is a small market correction. This isn't a market crash. Throughout history, the stock market goes through periods of bull markets and bear markets, but neither one lasts forever. Now, let me ask you a quick question. Since 1926 to today, what percentage of the market has been in the positive? Pause the video and leave a comment with your answer. The answer to this question is that 74% of the time, the markets have been up. So no matter what happens in the next 20 years, approximately 15 of those years are going to be positive. So basically what that means is that there is no need to panic and sell everything you own. So the big question here is that how can you prepare for a market crash? The number one thing you can do is anticipate it. Anticipation is key. Before the pandemic, we had 9 straight years of the market going up, and we recovered relatively quickly from the March lows. So it's important to anticipate a market crash or a bear market. And this is just historically speaking. The market does not simply just go up. So the second most important thing you can do is to build up a nice cash position. Every time a market crash happens, wealth is made by those who are prepared for it and have cash in hand. This is pretty obvious, but I'll explain a bit further. When you have cash in hand during a market crash, essentially everything is at a discount. This is true when it comes to stocks, but also real estate and many other things. So essentially, you're able to buy more with your money, and you get the real benefits of this when things go back to normal. So the anticipation of a market crash allows you to build a strong cash position so that when the day comes, you're ready to go out there and do some shopping. So the next question is, what do you actually buy during a market crash? Well, if you have considerable amount of cash sitting on the sidelines, you should buy value stocks. Value stocks that you know are going to bounce back relatively quickly. So if you have a good chunk of cash lying around, you can make a decent profit and offset the temporary losses that you're getting on your growth stocks. Personally, I always maintain a cash position that's somewhere between 10 to 15% of my entire portfolio. Number 3, buy gold and Bitcoin. I think it's clear now that Bitcoin isn't a hedge against inflation, or doesn't seem to be, because it follows the stock market. When stocks go down, so does Bitcoin, which is why you should try and invest in both gold and Bitcoin. Now, in case you're panicking and thinking about selling all of your positions, I just want you to listen to this last bit carefully before you make such a decision. From 1997 till 2019, if you were to take your money out at some point and missed out on the 50 best days, your portfolio would have been 60% less than if you would have left your money in the stock market. Just 50 days. So if you're in your early 30s or younger, you won't be as severely affected by a market crash if it were to happen when you look at this from a 20-year horizon. Because remember, historically speaking, the market has gone up 74% of the time. So the likelihood of you recovering your losses if you just leave your money invested are pretty high. Anyways guys, that's it from me today. I hope you found some useful insights from this video. If you did, please hit that like button and subscribe to the channel. Have an awesome day and I'll see you in the next one.